want to go back to this Jim Bianco question I asked in the last hour. I think it's worth asking of you because I know your answer to it, so we can have a broader conversation about it.
I'm glad someone knows the answer.
The disinflation we've seen over the last few months, is that transitory?
I think so, yes.
Why?
Well, because I think you had this big shock in COVID of excess demand and constricted supply, and that created a lot of it took a long time, but it was transitory inflation, and now you have a sort of transitory deflation. And what you see is that end demand is still there for physical goods. And you've seen PPI start to spin around back into positive territory, and I think CPI will follow course. Now, I would stress it's not going to be a wave anything like as powerful as what we saw in 21, 22, but I think it is going to stop CPI getting back into the twos and staying there. CPI is going to be sticky.
Is it a mistake to sound like you might be done then at the Federal Reserve?
Well, I mean, my view, I said it last time I was on, it's really about the long end of the curve, not the short end of the curve now. The Fed has sort of boxed itself into a corner. I don't really care if it stops at 550 or 575, because if you look at the range of long-term yields, I mean, the 10-year was at 350 in May and was knocking on 5% a couple of weeks ago. And, you know, I think that's really the question. I think the Fed has done what it's going to do in this monetary cycle. I think it's going to step away. I'm of the view that at some point in time, we're not there yet, that you're going to see some form of yield curve control brought in to stabilize the bond market. But that's not this week. That's not this month.
Hold on a second. Yield curve control in the United States.
Yeah.
Does that mean that essentially they're going to hold rates high, but that they're going to accelerate quantitative easing, like they're going to accelerate purchases in the long end?
I think at the end of the day, financial stability is the unspoken mandate of the Federal Reserve. They talk a lot about unemployment and inflation, but when things really come to a head, financial stability is number one. And we saw a taste of it exactly this time last year in the UK when the gilts market briefly dislocated. You know, I'm of the view that the Fed doesn't really have things under control. It's certainly not in control of the fiscal policy of this country. The fiscal policy of this country is reckless in the extreme. I think at some point in the foreseeable future, you're going to have disorder at the long end of the curve. And I think that's going to be important enough that it becomes something the Federal Reserve gets involved in.
So is that kind of what equity buyers are banking on? That essentially when they come out and they say stocks can handle bonds where they are, yields where they are they basically saying because if they get out of control, the Fed's going to step in regardless of what's going on with inflation? No,
I think they're just not thinking about it. I think that people spend an awful lot of time worrying about monetary policy over the short term, and the Fed feeds into this. They're constantly out there talking and like sort of hinting, maybe we'll do this, maybe we'll do that. And the sort of general sense the Federal Reserve wants to get out there is that it is somehow in control of things that it's palpably not in control of. I mean, I'd argue it's had no effect on inflation. It's totally lucky that inflation went away. It didn't go away because of what the Fed did. It went away in spite of what the Fed did.
Supply side rebalancing? Is
that
what's happened?
Absolutely. Yes.
Do you think that won't be sufficient then to get inflation down anymore? Have we seen the bulk of that?
I think we've seen the bulk of it. Now, the long end of the curve may have its own form of discipline. You know, I've said before that effectively nothing that happened from last October to this August really got transmitted to the long end of the curve. You know, that's no longer true. We've now transmitted another 75 to 100 basis points of tightening to the long end of the curve. The question is really what happens next.
Typically, those sell-offs can become self-limiting because ultimately you start to worry about a slowdown and people buy treasuries again. What I hear from you is that you think the budget deficit is a financial stability risk that this Fed's going to have to respond to. Now, if that's the case, let's run with that. Where does that leave the dollar?
The question is whether this is unique to the United States or whether it's something of a global malaise. If it's unique to the United States, the dollar gets significantly weaker. If there's a host of G7 countries which are running similar deficits and have forced down similar paths, then it's a hard asset story.
If this is the case, then do you foresee a certain level, a certain trigger for the Fed to step in and be able to justify additional purchases at a time where inflation is still expected to be hot?
I don't think there's a magical yield number. I don't think 5% or 5.25 in the 10-year suddenly gets the Fed jumping up and down. It's more the orderly functioning of markets. You can have a very orderly market with a 10-year at 5%. You could have a very disorderly market with the 10-year at 5%. I mean, I think the quality of auctions, I think the amount of bids that they get, I think the aftermarket response post-auctions matters a great deal. It wasn't that the yield in the UK was so high this time last year, but it was clearly a disorderly market. There was clearly massive forced selling in the institutional community, and that's when a central bank wakes up extremely quickly.
And fiscal policy risk was at the epicenter of that as well. Let's finish here. I can hear people screaming at home. Listen to this. Do I buy stocks or sell them? What do I do if all this happens?
I think in the short term, I think there's an investable market rebound here, and I still think there's portions of the equity market that are doing okay.
Is Washington listening, AMH, to this?
Well, a lot of people are, but doesn't mean they're going to react on it.
The privilege of acting recklessly just seems to have been lost.
This is the whole thing Moody's is talking about. It's the idea of governance that is not going the direction that it should, that is concerning them.
Yeah, but if any of these officials are looking to the stock market for any validation of their concern, we hear all of these incredibly doomy and gloomy prognostications, and then investor after investor says, but actually this makes stocks a pretty good buy for now.
Just process that. Budget deficit is a financial stability risk that this Fed has to respond to and commence yield curve control. And if it's unique to America, can you imagine the dollar weakness we're going to see off the back of that? If we remember what happened to sterling off the back of that story, what happens to the US dollar if that starts to materialize?
The key thing you said, if. Right? Because what we've seen, and it's a global issue. And what did we hear from Tony Dwyer? That basically higher rates are bad because this is an entire world leveraged to low rates. And it is not just a US-centric issue.
If you are just tuning in, welcome to the program. The S&P 500 here firmer by 0.4%. In the bond market, some calm, stability, 456. Michael Shaoul, that's not the calm you expect to stay, I imagine. Is this the base case for you now?
Yeah, I think at some point, I don't think it's going to happen this year, but I think at some point we are going to have, we're going to have a period of real instability, and that some of the sort of long-term funding that people have taken for granted. I look at something like the municipal world. I don't see how they manage themselves through the next 2 to 3 years.
Wow. These are huge calls, Michael.
I mean, it is and it isn't. The world will go on. It'll just be, there'll be ways of operating that became normal over the last 15 years that won't be possible over the next 15 years.